Forex becomes predictable when you understand one simple thing: currencies move because economies move. Most traders spend years staring at charts trying to decode patterns, signals, and indicators, but the traders who consistently predict major currency moves are looking somewhere completely different. They're watching interest rates, economic momentum, and global risk conditions. And once you understand how these forces interact, currency movements stop feeling random and start looking structured. This is where it gets interesting, because the biggest misconception in Forex trading is that price movements are unpredictable. Traders are taught that the market is chaotic, that anything can happen at any time, but when you step back and look at the bigger picture, you start to see that currencies tend to move in long sustained trends driven by macroeconomic forces. Those forces change slowly, which means trends often persist longer than traders expect. Think about what a currency pair actually represents. It is not just a price chart moving up and down, it is a comparison between two economies. When you look at something like the euro against the dollar, you are looking at the relative strength of Europe versus the United States. One side strengthens while the other weakens. The question is always the same: which economy is becoming more attractive to global investors? This is the part most traders never fully grasp. Currency markets are driven by capital flows. Trillions of dollars move around the global financial system every day. Investors allocate money where they expect the best returns adjusted for risk. Those capital flows create the trends you see on charts. Price does not move first, and fundamentals follow. Fundamentals change first, capital flows respond, and price moves as a result. Once you understand this, Forex starts to feel very different. Instead of trying to predict random movements, you're analyzing the forces that create direction. And this is where prediction becomes realistic. The single most important driver of currency markets is interest rates. Interest rates determine the return investors can earn on capital. When interest rates rise in one country relative to another, that country becomes more attractive for investment. Investors buying bonds, equities, and other assets need the local currency, which creates demand and pushes the currency higher. This explains why some of the biggest currency trends happen during central bank tightening cycles. When a central bank signals that interest rates will rise, investors anticipate higher returns and begin allocating capital before the actual rate increases even occur. The expectation of future policy drives the move, and this is where most traders get caught off guard. Markets are forward-looking. Currencies do not move based on today's conditions. They move based on expectations about the future. If traders expect rates to rise, currencies often strengthen months in advance. If traders expect rate cuts, currencies often weaken before the cuts even happen. This explains many of the moves that seem confusing on the surface. Sometimes a central bank raises interest rates and the currency falls. That happens because the market expected even more tightening. Expectations shifted and the currency adjusted accordingly. Once you understand that expectations drive markets, price movements become much easier to interpret. But interest rates alone do not tell the whole story. Economic growth also plays a major role. Strong economies tend to attract investment. Businesses expand, employment rises, and consumption increases. Investors want exposure to economies that are growing because growth creates opportunities for returns. When growth expectations improve in one country relative to another, capital tends to flow toward the stronger economy. That demand strengthens the currency. When growth slows, capital often moves elsewhere. This constant reallocation of capital drives many of the trends seen in Forex markets. Inflation adds another layer. Rising inflation often leads central banks to tighten policy. that can support a currency if higher rates attract investment, but if inflation becomes excessive and erodes purchasing power, it can weaken confidence and reduce demand for a currency. The impact depends on how inflation influences policy expectations. And then there is global risk sentiment, which is one of the most underestimated forces in Forex trading. When global markets feel stable and optimistic, investors tend to move capital toward higher return assets and growth-oriented economies. When uncertainty rises, investors become defensive and move capital towards safer assets and more stable currencies. This is why certain currencies tend to strengthen during periods of market stress. Investors want liquidity and stability when uncertainty increases. During periods of confidence, capital tends to spread into higher growth regions. These shifts can drive major currency moves even without significant economic changes. Now, this is where the breakthrough happens. Prediction in Forex does not mean knowing exactly where price will go tomorrow. It means understanding the forces that are likely to push currencies in one direction over time. When multiple macro drivers align, the probability of a sustained move increases. This is the concept of macro divergence. When one economy is strengthening while another is weakening, the gap between them creates directional pressure. Interest rate expectations diverge, growth outlooks diverge, capital flows diverge. These divergences often produce the strongest trends in currency markets. Professional traders spend a lot of time identifying these divergences. They compare economies, compare policy outlooks, and compare risk exposure. Instead of analyzing currencies in isolation, they analyze relationships. This relative approach is what makes macro analysis so powerful. Once traders adopt this framework, markets become clearer. Pullbacks within strong macro trends often look like opportunities rather than threats. Temporary volatility becomes easier to tolerate because the underlying forces remain intact. This is exactly the kind of structured macro analysis that MacroDrivers is designed to provide. Instead of trying to interpret dozens of disconnected indicators, the platform tracks the major forces driving currency markets, currency strength across economies, changes in macro trends, shifts in the global risk environment. The information is organized in a way that reflects how professional traders analyze markets. What's interesting is that once traders begin looking at markets through a macro lens, their decision-making becomes more consistent. They stop reacting emotionally to every price movement. They understand why markets move. They develop confidence in their analysis. Charts still play a role, but their purpose changes. Instead of trying to extract predictions from price alone, traders use charts to refine timing and manage risk. The macro framework provides direction. Technical analysis provides execution. This combination is what makes prediction realistic. And not perfect prediction, but structured decision making based on the forces driving markets. And once you see markets this way, it's difficult to go back to purely technical trading. You start to recognize the patterns created by macro forces. Interest rate cycles create sustained trends. Growth cycles create momentum. Risk cycles create shifts across multiple currencies at once. Forex stops feeling chaotic. It starts feeling logical. And this transformation is what separates struggling traders from consistent traders. The difference is not talent or intelligence. The difference is understanding what actually moves currencies and having a structured way to track those forces. If you're serious about predicting currency movements more effectively, macro analysis is the foundation. So that's exactly why MacroDrivers was built, to track currency strength, macro trends, and global risk conditions in a structured way that reflects how professional traders approach the market. Because once you understand the macro forces driving currencies, Forex stops looking like noise and starts looking like opportunity